Hey everyone, this is Kirk here again at optionalpha.com, and we're going to quickly go over in this video option contract multipliers. So this is really important. Bet some of you have never even heard that there are option contract multipliers, but I bet you it will answer a lot of questions for some of the beginners out there. So long ago, options contracts became standardized and thus fairly inflexible. This is actually very good. So what happened is that these standardized contracts created some uniformity in contract terms, sizes of the contracts, strike prices, and expiration dates. Think about what would happen if we did have an options contract for every single cent strike price for a stock, or expiration dates every 3 days from here on out, right? It would be absolutely crazy. So what they did is they actually made some contracts, or most of the options, that are fairly standardized in that they have set parameters for strike prices and set dates of expiration, so that it's just easier to get the market into some level of liquidity and efficiency. So a contract multiplier is just the multiplication factor that you're going to use for the price of that one contract, or what that one contract will control. So if a stock has options, it's called an optionable stock and will typically have consistent sizes of each option contract. So most options are going to be a 1:100 ratio, meaning that every one option is going to have a contract multiplier of 100 shares, or every one option will control 100 shares. So when you look at the price of, for example, this January 2012 390 call, you can see that the actual last traded price is 18.80. Now these January options have a 100 multiplier, which is designated by this 100 right next to the actual expiration date. So always check that to see what the multiplier is. But these 18.80 price in reality means that this option is going to cost you about $1,800. It's not $18.80. You have to multiply that 1880 by 100. Or usually what I tell people to do is just move the decimal place 2 places to the right and you'll get your price. So again, for these January 380 calls, you can see that the price is 23.85. That really means it's going to cost you $2,385 per contract that you want to buy. The key thing here is that, again, one option is going to control 100 shares. So at expiration, if you were to exercise your one option contract, then you could buy 100 shares at your strike price. So again, that's the real key point. Remember that with options, there's always this performance risk. So what they did is that standardized contracts now reduce the risk from other investors because they're very standardized in how they're traded. The OCC, which is the Options Clearing Corp, can guarantee every trade to make sure that the market remains active, it remains fluid, it remains efficient. So really the standardization is coming from them, the big guys. They want to have standard contracts so that it's easy to take care of and go through an expiration cycle with millions and millions of contracts. Again, there are millions and millions of contracts right now that are ready for expiration this month. Can you only imagine what would happen if you had strike prices at every cent and expiration every 3 days? It would just be an enormous market. There wouldn't be any liquidity. There wouldn't be any efficiency in the market. It would just be bogged down by its own volume and weight. So actually these contract multipliers, which standardize the contracts, are actually really good for the options market. So hopefully you guys got a little bit better understanding of what option multipliers are as they relate to the option contracts. So as always, thank you for watching this video. If you like the video, you can always share the video right below here on your favorite social network with any of your friends, colleagues, or family.